Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago soybean complex. Now I'll start with the Chicago soybeans themselves. Beans in the teens? Sorry, but no more. This had been threatened here for weeks, months even, and has finally come about. Now I said 5 weeks ago here how I'd noticed two possible patterns, not necessarily complementary. The first is a mid-June to mid-August ascending triangle. The flat topside trend line was capped by the resistance at 1459, whilst the broken rising mid-June to date uptrend, currently at 1388, is the lower trend line. Now I also speculate that the rising long moving average, currently at 1381, could be a dynamic contender for the same rising uptrend, or at least an influence. And now the declining medium moving average, currently 1416, would be a dynamic contender for the flat topside trend, or again as an influencer. Anyway, by late August the market broke down through both the long moving average and the lower trend line and continued lower. It is at this point I'd like to again mention the second related pattern which I'd seen. The bearish halfway hesitation that takes the action from early to mid-June, making the left flagpole now. The market has in reality made a bit of a mess of the right-hand flagpole for this. In part, probably a large part, has been due to the clash with the ascending triangle pattern. Nevertheless, prices have moved lower down through the lows of June, and in recent weeks reaching the old target X in the 1290 area. This was the original primary target for the ascending triangle pattern, achieved 3 weeks ago, and this is where we've seemingly held last week, for now at least. So what's next? Well, given that we've had, as recently as this past Tuesday, a daily key reversal down, it would seem reasonable to look to the downside first. So below, we have two potential targets. Target X1, the secondary target for the ascending triangle pattern in the 1202 area, and target X2. That's the first possible bear flag target in the 1178 area. The problem with that latter one is that we have in between the two key 50% Fibonacci line supports of the April 2020 to May 2021 move at 1243 and the 2019 to May 2021 move at 1229. Now these two 50% Fibonacci lines are quite new and only finalized back in May this year, but they are still there. Otherwise, there are limited supports available until the 1140s. As for the top side, well, the declining short medium moving average, that's currently at 1350, is the first obvious choice, but I suspect the flatlining long moving average, currently 1381, it would be a better resistance. Okay, so I would normally leave it there, except I had a short and very interesting conversation with Andre Sheckman in Brazil, a good friend of mine, also a technical analyst. He asked me to look at the whole of the 2021 action here as a possible head and shoulders top, and I have to say, what he has asked does indeed have merit. I'm going to ponder upon this a little more, as it does not have as clear a neckline as I would like, but I can say this. The market is currently hesitating right on the area a neckline would be drawn. Caution, therefore. Chicago soybean meal. I wrote some 9 weeks ago, and I quote, "The month of May was a monthly key reversal down. It is important to remember that," end of quote. And what I wanted to emphasize by that is that everything since has been in the shadow of that pattern. With this in mind, you can see how during June the market broke down through the long moving average, currently 396.10, dropping down through the lower time, currently 303.5, of the bearish 2021 Andrews pitchfork, then bouncing back up and by subsequently just going sideways since July, run along the underside of the middle time, currently at 349.90. As part of this process, the market has since late June also created a lower trend line, currently at 345.20, and thus drawn a descending triangle pattern since June. Last week, prices punched down and made consecutive closes below the lower trend line. This raised and has so far confirmed a break lower out of the descending triangle. And a move lower has been enough to finally reach target X in the 337.20 area. This was the original target for the bear flag seen during May and June. That came close, but has only been fulfilled, as I said, late last week. So where now? Well, an initial target X1 for the descending triangle is in the 326.10 area, whilst the secondary target X2 would be in the 306.80 area. This of course assumes the current move lower is a genuine break lower. Now, as a final point, I would like to once again recognize the wonderful job the bearish Andrews Pitchfork for 2021, originally drawn back in May and mentioned since, has done in channeling the market lower. It has been useful and valid up until this very day, and perhaps for some time forward. That is the key to the market here, the bearish Andrews Pitchfork. When it gets busted or adjusted to a bearish shift pitchfork or some other pattern, then we can look for new ideas. But until then, that rules the incentive in this market. Chicago soybean meal oil. For many weeks, going into months now, I have highlighted the rather lopsided diamond pattern seen over May to July. Looking again today, I find it still to be the key pattern here, but it has some competition now. Now, a few words first on the diamond pattern. Diamond patterns can be tops, bottoms, or continuations. In this particular case, it is a top. Back in late July, the market broke down through the lower trend line, but did not immediately follow through lower. Instead, the market chose to run along the underside of the broken trend line. This stopped when the market reached the right-hand side apex of the diamond at the end of July, thus provided additional weight to the diamond pattern breakdown being a genuine action. Anyway, prices dropped and they came across an obstacle, primarily the rising medium moving average, currently 61.96, and also at the time the unreconstructed November 2020 to date uptrend, which has since been moved. Between these two, they halted the market during early August, but gave way later that same month. Since then, prices have started channeling lower, though I prefer the idea of them moving lower within a descending wedge pattern, at least for now. Most recently, the market has been tackling the congestion between 57.64 and 59.44, which you can see as a striped band across the middle of the daily chart. Today has broken down through it, but do not get too excited just yet. We did the same back in late August, and we subsequently had a pullback up, so watch and see. It still nevertheless brings us closer to the targets for the diamond pattern, and that's the initial target X in the 55.90 area and the secondary target X1 in the 53.80 area. The main obstacle to getting to both targets is the gently rising long moving average below, currently at 54.15. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.